My first talk today will be on Minsky, Godley, and financial balances. I will mainly concentrate on Godley. Randy just talked quite extensively about Minsky, and I know Godley much better since I started to work with him in the 80s and continued through the following years. They both have an approach in which they focus on the interplay between the real and financial markets. And I will particularly focus today on financial balances, which have been mentioned several times in these days, starting from the very first speech of Stephanie, who explained the buckets of the private sector balance, the government and the foreign balance. And again, Randy mentioned the balances a few moments ago. So I will try to give some more substance and some precision on how we measure these balances, how can we have different views on these balances, where they come out from. And actually, Godley is connected to these financial balances, but not because he invented the balance sheet, obviously, and most of the approach that I will talk about was developed by the national accountants, Copeland and others before Godley. But Godley in Cambridge in the 1970s, 60s and 70s and later started to use the balances of the three sectors, of the private, government and foreign sector for a model. And this is one approach that is due to him. So when we talk about the three balances of the economy, we are talking about Godley's approach and not about an accounting perspective on how to present the data. The stock flow consistent approach is what is now the label of this Godley type approach to modeling. It has become successful mainly after, at least in the United States and then elsewhere, after Godley published this 1999 paper with the Levy, 7 Unsustainable Processes, which predicted the 2001 recession at a time when everyone was so optimistic about the dot-com bubble, or the internet companies that had just started and they were growing so quickly. And most mainstream economists were predicting that the economy was going to grow forever with wealth for everyone. With the same type of approach, Godley and his team predicted later the Great Recession. And in 2007, 2006, 2007, he published with Mark Lavoie Monetary Economics, which is the holy text for the SFC approach. And after that, I think I can say that the SFC approach has become a standard for anyone doing macroeconomics in the post-Keynesian tradition, and more also in other traditions. So the strength of the approach is that it provides a flexible structure that connects the expenditure decisions relative to the goods and service markets to the implications of such decisions on financial markets, and then on the other way around, on the implications of the accumulation of financial wealth or financial debt on expenditure and saving decisions in real markets. And the other strength for those who do empirical work is that the accounting of the SFC is exactly the same as the accounting which is suggested for all countries in the world by an internationally agreed manual. So not all countries have already produced all the tables that I will present to you today, but most of them have done so already, and others are quickly joining. So that the type of data which is used for these type of models is becoming available for all countries in the world. To begin with, we need to choose the level of detail of the different sectors of the economy that we want to discuss. And this is what is usually recommended in this world level manual. So there's a distinction of the domestic economy against the other economies, a distinction between the public sector and the private sector, and the private sector into households, etc. Now, you may think that these are all rather standard, but instead, all of these distinctions are based on arbitrary definitions. So, the domestic economy can be the national economy, so anyone who has the nationality belongs to it, or it can be the domestic economy in terms of the boundaries of the country. And again, the public sector and the private sector, what's public and what's private, the distinction is not so clear. Well, obviously, in the public sector, you have all levels or layers of government, but for public companies, which can also be privately owned, there is, again, a gray area. And for instance, this gray area has been used by Eurozone countries when they had to agree to the Euro Treaty, the Maastricht Treaty. They had to get to this 3% in the deficit to GDP ratio and the 60% in the debt to GDP ratio to enter. So all countries said, well, if our publicly participated companies are profitable, let's keep them in the government. If they're making losses, let's put them into the private sector. And this gray area allowed them to play this game and reduce the accounting of their debt or deficit. And again, for the private sector, the household sector is in principle composed by the units who provide labor to firms and consume, but in practice, the household sector is also made up of all very small businesses. So when you go and look at the data, you will find that this household sector is also producing a large part of the value added of the economy. And again, we will have non-financial business and financial businesses, which in theory are distinct. In practice, they are interconnected. Now, if you go to buy a car, you are mainly sold financial services to get a loan to pay for your car, etc. So anyway, we need to have some distinctions. You should know that these distinctions are arbitrary, but they form the basis of how you can set up a model of the economy. Now, any macro model who wants to be stock flow consistent must adhere to a number of principles that we will go through, which are very simple and may sound trivial, but are not so trivial as they may sound. So the first one is so-called horizontal consistency, and it implies that any payment made from somebody in one sector to someone else in another sector must be recorded. So a payment made by someone is an income from someone else. So money does not disappear or appears from nowhere in their model. And this may seem obvious, but if you think of the simplest textbook model, the ISMM model, there you have an interest rate, but you don't have interest payments. So interest payments just disappear in the model, and if you use that model, you're not able to understand the role played by these capital income payments. One way to make sure that a model adheres to this horizontal consistency is to use a transaction matrix. So in transaction matrices, you record in the columns all the institutional sectors. I usually also add a column for the production, and you include with a plus sign the money that the sector is receiving, and with the minus sign the money paid out by some other sectors, so that the horizontal sum must always be zero. Here I only made the first part of a simple transaction matrix with the demand component of GDP and the income component of GDP. GOS is the gross operating surplus, are the profits which are obtained by the different sectors of the economy. In a minute, we can also see how this can be estimated for the United States. For the United States, most of the work on this has been done by the Bureau of Economic Analysis jointly with the Federal Reserve. They produced the sets of accounts called the Integrated Macroeconomic Accounts, present all the tables that I will go through today. But they still don't match the requirements of stock flow consistency, because they don't identify the sector making a payment and the sector receiving the payment. So if you want to build a model out of this data, as we have done at the Levy, you have to do some additional work with additional sources or with theory. In the next slide, I will give you my estimate for the United States in 2020. 2021 is not available yet because profits have not been published yet. And I just listed a number of figures that will look a little higher than usual and higher than normal. So in the column for each sector, you have with the plus the sources of liquidity, with the minus the uses of this liquidity. And basically, therefore, going from the top to the bottom, you have how income is obtained for the household sector, and then how the household sector spends it on consumption. And if you also deduct gross capital formation, which is investment, you get to what is called net lending. So net lending is in the jargon of national accounts, is what we call the financial balance. So it's the difference between the money that the sector has obtained less the money the sector has spent on both consumer goods and on investment. The same applies to NFP, which is non-financial business. For the financial business, the government and the rest of the world. You can see that in this particular year, the government had a large expenditure on net social benefits, which were money transferred to the household sector to cope with the pandemic in 2020, and this implied a larger than normal government deficit and a larger than normal surplus or net lending for the household sector. Other things may stand out. One thing which is interesting usually is the distribution of income between wages and profits, which you can see at the top left of the table, and also the sides of the dividends and interest payments, which are an indicator of the non-wage income for the household. So in this transaction matrix, we can derive the financial balances for all sectors, and simplifying the accounts, starting from the basic GDP identity and subtracting taxes on both sides and adding net transfers from abroad on both sides, we get to the disposable income of the private sector on the one hand, and on the right-hand side, on the third line, you have the government deficit plus investment plus the current account balance. Now, subtracting investment from both sides, you have what I call the net lending of the private sector, or the financial balance of the private sector given by aggregate saving less investment. And this must be equal by accounting identity to the government deficit and the current account balance. Obviously, this accounting identity always holds in accounting terms. In economic terms, it holds when aggregate demand is equal to aggregate supply. So when aggregate demand is not equal to aggregate supply, then also there will be some kind of relation among these balances. And it's also important to note, and I will get back to this later on, that the saving of the private sector is actually can be split into the saving of the household sector, and the investment of the household sector is also considerable, and the saving of the business sector, SB, which is basically undistributed profits less IB. Now, just allow me to open a quick bracket. Randy mentioned a few minutes ago the Kaleski equation. Now, the Kaleski equation is obtained from this slide. Basically, if you assume that investment is all done by businesses and that household are made up of workers who consume all of their income and capitalists who don't consume anything, then the saving of the households of the workers will be zero, and what is left is the saving of the capitalists, so that this equation becomes what I called SB, equal to investment plus government deficit plus the current account balance. So Randy may correct me if I'm wrong, but I think that this is the Kaleski profit equation. So much for the first principle of stock flow consistency. The second principle is called vertical consistency, and basically implies that every time someone makes an expenditure, she will have either a reduction in her financial assets, or one of her financial assets, or an increase in one of her financial liabilities. So if we pay cash, our cash balance drops, and this is our financial assets and so on. And since the horizontal consistency implies that when I'm paying someone, someone else is receiving money, we can consider the horizontal and vertical principles together, and they imply that for every payment, we must have 4 entries in the accounting. Now, where do we record these changes in the assets, financial and assets and liabilities? And they are recorded in a new matrix, which is called the flow funds matrix, which details all the possible forms of financial assets in the economy. And obviously, they also must respect the fact that if I'm borrowing and someone else is lending, and in the act of borrowing, we have to have these 2 recordings for the 2 sectors. So in a very simple theoretical flow fund matrix, we will have the deposits, usually deposits increase as an asset of the households, and they decrease as a liability of banks. The FB column is for banks. Loans, when firms or households take a loan, this will increase their financial liabilities and increase the assets of the banks by the same amount. When the government is selling new bonds, they will become financial wealth of whomever buys these bonds, and the financial liability for the government, etc. And we also have data, obviously, for all these, but they are organized in a somewhat different way. And this list is the standard list that every country has to produce. Then countries with more resources produce more details, but most countries have this type of detail. The problem, again, is that not all countries record who is issuing, let's say, who is selling a bond and who is buying the bond. So they're not matching the creditors to the debtors. Again, I prepared an estimate of the flow fund for the United States for this lecture. And again, for 2020, I highlighted in yellow the numbers which I thought were more interesting at this time of pandemic. So you can see that there was a large increase in the debt securities issued by the government, and a similar, even larger increase in the debt securities bought by financial businesses. But as you can see, in the table as it is presented, all sectors are potentially issuing loans and taking loans, issuing bonds and buying bonds. So you have to, if you want to model this and understand how these things work, you need to first of all get additional data if they are available, but next have a theory on how these things are related. Now to the third principle, and I think I have to go a little quicker. The third principle is how to connect the flows of changes in financial assets and liabilities to the end of period levels of the corresponding stocks. And this implies getting to understand capital gains. So we all know how a physical stock accumulates over time. And hopefully most of you already know how monetary stock accumulates over time when there is a market price. So if the value of houses in the United States at the beginning of 2022 is, let's say, 1 trillion, and the average house cost is, I don't know, $1 million, and this implies that you have how many? 1,000? No, 1 million homes at $1 million. This makes 1,000 trillion. Anyway, if you build additional houses during the year, the value of the houses will increase. But if the price of existing home increases, this is another reason why the value of the housing at the end of the year will be larger. And this is what we call capital gain, and we record in what is called the revaluation account. These revaluation accounts were particularly important in the recession of 2001, when we had the internet.com bubble and the stock market went very much high, increasing investment, and then the bubble burst and we had this huge fall in the stock market. And again, in the years before 2009, before 2007, when the price of housing kept rising, and we had a bubble on the housing market, which again collapsed. It may be very relevant again in the coming months because again the stock market is increasing much faster than the economy. Also, the housing market is increasing again, and it's not difficult to predict that if the central banks will increase the interest rates, this may burn these bubbles and create a collapse. So something to think about, these capital gains are capital losses from someone else. And in principle, this is true. We may discuss this later if you're interested, but in practice, if we have capital gains, those who feel the capital gains are increasing their wealth will spend more, but those who would suffer the losses do not care. So these capital gains prove to be important at the aggregate macroeconomic level. Also, these capital gains are recorded in the accounts, in the revaluation account, and they are very large in periods like this one. So, for instance, the corporate equities in 2020 had an increase in market price, which implied a 4 trillion increase in their value for their holders. And the real estate had an increase into 2020, which implied a larger value for these home owners of close to 3 trillions. So you can see that the magnitudes of these effects are extremely large. Now to the fourth principle of the stock consistency, and this is quite obvious if you followed me through the other principles. So this is basically just saying that in the balance sheet, the assets of someone must be a liability of someone else, and therefore the net financial wealth for everyone, including the foreign sector, must always be zero, and the wealth for the world as a whole is only made up of real assets. The wealth for a single country is the real wealth plus their net foreign assets, and again, the wealth of the private sector is the real assets of the private sector plus the credits against the other two sectors, credits against the foreigners and credits against the government or government debt. And again, this is the same matrix as before, but now for the end of period stock. And these are the numbers that I have put together for the United States in 2020. I did this rather quickly, so I hope there are not too many mistakes in my spreadsheet, but basically this gives you an idea of what type of assets are most relevant in the United States. Now you can see the market value of the equities is even larger than the market value of the real estate of the household sector in the US, which is quite impressive also because the market value of the equities is very volatile. Last principle of stock flow consistency is that these stocks, the balance sheets, they have implications for expenditure decisions, as well as having, we could say, quasi-accounting implications. So if you have a given level of debt, given the interest rate, this determines the flows of interest payments that you will have to make. And the less obvious implication is that if you're accumulating financial wealth, for instance, if the households are accumulating financial wealth, it must be because they want to spend it sooner or later. So in the macro model, which wants to respect this principle, you have to have a connection between the level of wealth and the level of expenditure. It's not so obvious. It's more complicated, for instance, to understand the relevance of other stocks, such as the stock of wealth of the non-financial business sectors. Should this be relevant or not? This is a complicated concept because this net stock of wealth of the what I call NF here will be made by real assets on the one hand and liabilities on the financial side usually. In theoretical models, it's simple theoretical models, these two are the same, but what if they're not the same? So again, if you want to have a completely stock flow consistent picture of the economy and you have this non-zero net wealth, you also need to specify what are the implications for the behavior of businesses. Now, let's move more closely to financial balances. As I already mentioned, Godley Cambridge proposed with this so-called New Cambridge approach putting together the households and the business and also the financial sector in a unique private sector. And he called the financial balances, this private sector, NAFA, for net acquisition of financial assets, would be what we call net lending for the private sector as a whole. And the group noticed that this NAFA was relatively stable relative to disposable income, and this implied also that the government deficit plus the current account balance had to be relatively stable relative to income. Now, they were quite successful in understanding what was happening in the United Kingdom at the time, but from an academic point of view, they were criticized because the fact that they had this private expenditure function, which put together the decisions of households on consumption and the decisions of business on investment, was considered to be at odds with the macroeconomics of behavior. So one first way out that Godley and Cripps had in their macroeconomics textbook of 1983 was to say, look, we are dealing with stocks and flows. So think of a lake, which has a river with an inflow of water, another river with an outflow of water. Now, when the system is stable, by stable we mean that there is a constant inflow and a constant outflow of water, then you can verify that the ratio of the stock of water into the lake to the net flow of water, net flow meaning the water coming in less the water going out, will be stable. So you have a stable stock flow norm. But if some shock perturbs this system, so let's say you build a dam and the amount of water flowing out is reduced, then the ratio of the stock to the net flows will change. So Godley said if a system is stable, will also be stable in what is called stable growth, then the stock flow ratios will be constant, will be stable. So if we look at these stock flow norms and we see that they are varying in the economy, there's signal of some perturbation, and we may look for what makes them converge to their stable value. So this is one way to approach this three-sector representation of the economy. Maybe now these new models of the that are being built, making investment completely endogenous, the super multiplier models, reach similar results. So if you have a super multiplier model, you basically have that both consumption and investment react to demand, and therefore it's not so far, from some point of view, from the Godley's approach to the aggregate private expenditure. These are the financial balances for the United States. So you can see that the assumption of the New Cambridge is quite in line with the data on the US up to the 1990s. So the NAFA is the red line relative to GDP, and this was always positive and fluctuating, but not so much, and very much close to government deficit, with the current account balance, which was fluctuating in a small range between positive and negative values, as Randy mentioned in the previous talk. So basically, in the US, you had the net financial wealth of the private sector was mainly made up of the net financial liabilities of the government sector. Then, in the 80s, as Randy already told you, we started to have a deterioration in the current account balance, and therefore this reduced the NAFA of the private sector. And when Clinton started to reduce the government deficit, this implied an even further drop in the NAFA. When the NAFA goes negative, as it happened in the second half of the 1990s, this is saying that the private sector as a whole is either increasing its debt against the other two sectors or running down its financial assets. And these are causes of financial instability. So this is the main reason why Godley wrote his paper in 1999 predicting a recession. And you can see that after 2001, the government intervened, increased expenditure, and this for some time brought the NAFA back in positive territory. And now, when the housing market bubbles started again, the NAFA went negative again, and we were able to predict the 2009 crisis, which happened, the 2007 crisis that happened. Now, in 2020, you have this 2021. You have this very large increase, which is due to the pandemic, but I think that the balances will turn very quickly. The NAFA may turn negative rather quickly. And here we also have the distinction between households, non-financial business, and the financial sector. So one may wonder, but why do we also keep the financial sector into the private sector as a whole? We can discuss this, but this is not so crucial because in normal times, as you know from the other talks you listened to in the seminar, the financial sector is creating assets and liabilities at the same time. So when the banks make a loan, it's creating, in a sense, a debt for someone in the non-financial sector, but it's also creating a deposit, which is an asset for someone in the non-financial sector. And for the financial sector, the value of assets and liabilities being created will be the same. So from this point of view, it should not matter that much whether we have the financial balance of the financial sector inside the picture. In non-normal times, as it happened in 2009, then the banking sector may want to recapitalize. So I think what they did here was to put aside some money to rebuild their balance sheet after the crisis. But other than that, this is not so important. The other thing which is also interesting is that it's not always true that the non-financial sector is always borrowing. So in many cases, the non-financial sector has been able to finance most of its investment with retained profits and also to accumulate some financial assets. So hopefully we have understood where these financial balances come from. What are the possible configurations of the balances? So the first two cases are quite trivial. So in the first case, we could have that, as in any simple textbook, that households don't invest, business do not have retained profits, government has a balanced budget, and there is no current account in balance, so that the saving of the households are equal to the investment made by firms. And then you have the two stories of whether it's the saving which determines the investment in the marginalist approach, or the other way around in the Keynesian approach. And the other theoretical case is where there is no financing from the households to the business sector, and the household sector is in funding investment in housing through saving, and the business sector is funding investment through profits. But again, this is non-realistic, although the amount of housing investment financed by saving of households is quite large. I don't know what happened to this slide. The third, now more plausible case is when the NAFA is zero, so the private sector is not accumulating or decumulating financial assets, and this implies that a government deficit will imply borrowing from abroad. The other cases are the case in which the NAFA is negative. So if the NAFA is negative, as I mentioned, the private sector is either running down assets or accumulating debt, and this happens mainly when we have a current account deficit or a government wants to go into surplus. And this historically is one of the major, most probable reasons for a financial crisis. So in this case, we have the private sector indebtedness is matched usually by indebtedness with the rest of the world. And in this case, we can have a positive NAFA given by a current account surplus, and we may assume that the government is balancing its budget. And this is what I call the export-led case run by Germany, for instance. So you may think that this is a positive possibility because the private sector is accumulating financial wealth, but it is doing so at the expense of foreigners. So foreigners somewhere are accumulating debt. So this is exactly what happened to Greece and Germany. I will talk a little about Greece on Saturday, but basically when Greece joined the euro, they had a large reduction in interest rates and they started to borrow to buy their car or to take a mortgage, and financial markets operated in such a way that the German and the French and the Italian banks were providing the liquidity to the Greek banks to pay for these loans. And in the end, when Greece was deemed to be bankrupt, this implied the European crisis. More on this on Saturday. Finally, the stable alternative is what we call the MMT view, which is that something is taking care of the current account balance, usually a flexible exchange rate, and the private sector is accumulating financial assets, which are liabilities of the government. How does this work in practice in the countries around the world? So I have this chart, which is from my chapter on an MMT book, which will, I think, come out sooner or later. And here, the chart is the chart that was in this slide that I am unable to show. So I have to comment it from here. So with a suggestion from Rob Parenteau, we can draw the balances in a diagram where we have the current account on the horizontal axis. So we have a surplus on the right and the deficit on the left, and the government balance on the vertical axis, so that we have a surplus on the top and the deficit on the bottom. And we can draw the diagonal And the diagonal, which is not so diagonal in here, uh, is where the surplus of the government is equal to the surplus in the current account, and this implies a zero NAFA, a zero net lending for the private sector. So when we are below the diagonal, then the private sector as a net lending position is accumulating net assets. When we are above the diagonal, we are in the opposite situation where the private sector is accumulating debt. And you can see that before the 2007 crisis, a lot of OECD countries were above the diagonal. So the private sector was getting into more and more debt. After the crisis, most of the blue circles are below the line. So the crisis pushed the economies there. I also made a statistic to check how many countries have a positive NAFA, how many have a negative NAFA. And basically, the countries with a negative NAFA most of the times also have a negative current account balance, or they are financial centers. And countries with a government surplus, such as Germany, Norway, etc., usually are running an export-led strategy. So, for instance, Norway is exporting oil, so they don't care about having the government surplus because the current account balance is large enough to not allow the private sector to reduce its net financial assets. Can we say that one balance is causing another one? And no, the answer is no. You need a stock flow model to explore how the balances move and what is determining what. But people are still trying to do this with econometrics, and it is not so successful. Very quickly, because I'm running out of time, I presented all the accounting of stock flow models, but then you need a closure or closures, which are theories which explain how the components of income and the components of the balance sheets, etc., are determined. And this is what you need to endogenize in order to have a proper model. Can we have mainstream closures? Possibly, yes. I only know one model which has been produced for South Africa, if I'm not wrong, with mainstream assumptions, and it is not at all interesting. Today, there was a presentation of a model at the Italian Treasury, and the authors are not heterodox, they are mainstream. And it was interesting because I intervened and they admitted that they were using Keynesian assumptions to build the model, and that the model has nothing to do with DSGE, had nothing to do with general equilibrium. But we can talk about this again in the Q&A later. So most of the stock flow consistent models are post-Keynesians. And we also discussed the fact that SFC is a bad label for our class of models because SFC, stock flow consistent, is an accounting requirement that can be adopted by anything and does not explain our view of the world. And out of equilibrium models is much better, but now SFC has become the brand, as MMT has become a brand in a sense, and therefore we are stuck with our SFC label. In any case, all these post-Keynesian SFC models are demand-driven. They do not have a separation between what's driving the economy in the long run and what's driving the economy in the short run. The long run is nothing but a sequence of adjustments in the short run. Usually, we don't have price clearing between demand and supply, at least for goods markets or the labor market. We may have them for some financial markets, but we have adjustment to quantities, or what are called buffers. So, for instance, households may decide on the composition of their portfolio on the basis of the expected return on each type of asset, but at the end of the period, they may find that their expectations were wrong, and they end up with one of their assets being too high or too low against their expectations. Usually, their end of period stock of money will be either too high or too low with respect to their decisions. Another important aspect is the treatment of time. As you know, in neoclassical models, time has nothing to do with reality, because neoclassical mainstream models are a sequence of equilibria. In post-Keynesian models, we usually adopt theories close to the monetary theory of production, and therefore the concept of time is related to the time it takes to complete a production cycle or to complete a financial cycle. So the starting point of a financial cycle is when firms get a first loan to pay for wages and start production. And when production is complete and sales are made, firms recover the money that they receive from banks, can pay back the initial loan, and when all the money which was injected at the beginning is destroyed, the financial cycle is complete. But again, we can discuss this later because it's a long story, but it attaches a time dimension to our models. Obviously, we assume money endogeneity, and I don't think I have to spend too much time on this. SFC models are also being adopted in heterodox microeconomic models, mainly agent-based literature. And in that case, these models are becoming interesting. We can spend some words in the Q&A if you're interested on how to model the composition of portfolios, because in theoretical models, Godley, the SFC uses the Tobin approach, where the share of each asset in the portfolio depends on relative rates of return. When you try to fit this into the data, you get big headaches. So in empirical models, we're usually more pragmatic. Finally, we use estimation for all the models that we have produced. We have a model for the United States, which was made by Godley with my research assistants many years ago and has evolved over time. We have a model for Greece, but other models have been produced in a similar way, one for Italy, I did one for Ecuador, and they're all based on econometrics. Other SFC models have been developed by other teams which rely on calibration. The most famous one is the one published by the Bank of England for the United Kingdom. And they basically use calibrations to avoid these problems I was mentioning on estimating the Tobin sense of equation. I mentioned this model for Ecuador, and I was quite happy to see that these demand-led models also apply for developing countries. There was this model presented today at the Italian Treasury. It was very interesting because they had a commentator from the ECB which said, well, but what does this model do better than the DSGE? And everybody in the room knew that DSGE models were completely useless in understanding the Great Recession and also later. So it was interesting because it was a mainstream, in a mainstream environment. They were accepting that their set of tools is inadequate and they're putting money in the development of these tools that we have adopted years ago. The pity is that they're not giving the money to us. Anyway, I think I've finished. And if you are interested now, after my talk, we will have a first lab. I'm sorry I will not be there to put the ends on your computers, but Michalis will be there. I will publish these slides as soon as we finish, and therefore you will be able to have this link to a set of lectures I gave in Berlin earlier this year on how to build empirical models. And these are other useful links to further references. And that's it. Thank you for your time. I'm ready for questions, but I need to hear the questions. So,
right. All right. So I'll go ahead and call on anybody. Okay.
Thank you so much for the talk. I was wondering, could you go a little bit, so I am not familiar with stock flow consistent models so much, I just know like firm level accounting, and I was wondering if you go a little bit into where depreciation is accounted for, both in terms of government accounts and also firm accounts. Like what's the flow to account for that loss of stock? Thanks.
Well, depreciation was not in my slides, but basically in the dynamic accounting of the stock of capital, you have that the stock of capital increases with gross capital formation and decreases with depreciation. So basically in the accounts, depreciation will appear as part of the gross operating surplus and will disappear with the gross capital formation here. And when you separately model the accumulation of capital, then you can use the figures to derive the net stock of capital from there. I hope I answered your question.
Hi, thank you for the presentation. I have two questions about your transaction matrix. First question is, I don't know why you put import entry falls on the production sector instead of household sector. And second question is, how can we handle when imports are used as intermediate goods for production firms, like a two-sector model? For example, the imports from the foreign sectors can be used as the intermediate goods for the final goods sector. So in that case, how can we use within the transaction matrix, or we have to just ignore because it is like a double counting?
Well, thank you. Actually, the transaction matrix is only one of the two ways in which you can present the accounts. The other one is the social accounting matrix, which is closer to the input-output approach. But in both cases, first of all, imports are, as you say, both imports of final goods and intermediate goods. But also, the final goods are not bought directly by households. You know, when you go to buy, let's say, a Chinese meal, which is shipped from China, you go in a local store which has bought it from the Chinese supplier. So you're basically paying a local business. So it's easier to consider in an aggregate model all imports to be first purchased by the production sector of the domestic economy and then sold to the final users. And having this set of accounts for production separately is also useful because it makes it easier to integrate let's say, an input-output system where you consider different industries into your model. And there has been some papers which have done that. And in that case, you can also have a disaggregation between intermediate goods and final, intermediate imported goods and final imported goods, as well as intermediate domestic production and domestic production for final users, for final use.
Thank you.
Thank you for your presentation. Broadly speaking, could you tell us which are the main parameters that you need to estimate with econometrics techniques? That would be the first question. And the second one, the forecast. What you are trying to forecast when this model is the growth rate or the investment rate or I don't know. And how are the other forecasts, the DSGM models, which perform better, the stock flow or the DSGM models? Thank you.
Yes, so here is the list of everything we have to estimate. So components of expenditure implies consumption of households, investment of firms, and then obviously it depends on the purpose of the model. So when the Levy model is meant to track the main variables of the economy, so the unemployment level, the level of GDP, consumption, investment, components of trade, and so on. But if you build a model of this type for the government wants to have more detail on how particular tax rates affect consumption or imports, etc. So you want to develop this into more detail. Other parameters that are implicit in here is if you want to have an explicit endogenization of the demand for assets, then you need to estimate the demand for loans, the demand for mortgages, the demand for bonds, etc. So the more detail you put into the model, the more parameters you need to estimate. Then the last question is how do you compare the performance of these models against the SGE? I will talk about this on Saturday as well, when I will talk about Levy forecasts. But basically, this is a big problem because how do you compare two models? This is also our problem every time we produce a strategic analysis. So our models are not meant to give a good forecast of GDP in the next quarter or in the next year. They are meant to provide a coherent, consistent view of what is happening in the next 1 to 3 years, conditional on the policies that are adopted. So the strength of our model is that if you increase, let's say, government consumption, then the model is tracking the consequences on the current account balance, on consumption of households, and therefore on the accumulation of wealth and debt of all sectors, which is not usually done in DSG models. So it would be unfair to compare a DSG model with an SFC model on their ability to predict GDP in the next quarters. If we look at which models were able to predict the 2007-2009 crisis, was one young researcher did that, and he found that most of the models who predicted the recession were based on flow of funds analysis, and Godley's model was the only one who had a complete structure. So his view was that these class of models were better in predicting a crisis. And, this goes back to a famous sentence by Keynes, who said that the macroeconomics before him was predicting that in a storm, the weather will eventually turn all right again. And economics was predicting that when you have a storm, the weather will become good again sooner or later, but it does not give you any tool to survive the storm. So we could say the same to DSG models. DSG models are models of long-run equilibrium. They all say that the economy will go back to the potential output, but are useless when the economy is hit by a major crisis. Stock flow models are useful to understand how to manage a crisis. I don't know whether they are better or not to predict the long-run or short-run outcome. So far, they have served us better in difficult times.
Thank you very much for the presentation. Technical question, because in fact I'm building like Godley and SFC models, and I have an issue when I'm building like private debt deflation, is that I have like a Fisherian indefinite and infinite equilibrium, because in a SFC, basically you cannot make a default on your loans. So would you have like technical solutions or balance sheet consolidation in order to make defaults, in order to have like a Minsky cleansing and a new cycle of financial stability and stuff like that?
Yes, there are models published with defaults. So basically, you can estimate the condition of default, and when someone defaults on a mortgage, you write down the asset in the balance sheet of the bank and the liability in the balance sheet of the household. So you can do that. It's not difficult.
Hi. Obviously, the role of financial derivative instruments linked to mortgage bonds, had a debilitating effect on the financial system. How would like the nominal value of derivative contracts be accounted for using the stock flow approach? Would they just cancel each other out, the net balances?
I'm afraid I don't know the answer to that. So you want to know the derivatives, how the derivatives can be treated in a stock flow model. Is that right?
Sorry? Yeah, just is there a way, for those to be accounted for as a means for sort of, I don't know, like risk management or something on a stock flow consistent model?
Well, my view is that if you want to discuss these issues, this type of financial assets, which imply a bet on future circumstances, right? Then you need to have at least two agents which have different bets. And it's very difficult to implement this in a macroeconomic stock flow model. It's much better to go on an agent-based model with heterogeneous agents with different ideas, and then you have the stock flow consistent closure. But what you are interested in modeling, I think, is difficult to achieve only at the aggregate level. I would suggest that you look into the agent-based literature for this.
Okay, that makes sense. Thank you.
So I don't know if this is too similar to some other questions, but I was interested in your slide about capital gains, which could be of a real asset, as I understand it, or I think same treatment of like stock or just a pure bubble asset, like a pure speculative asset. And is there just sort of a decision that's made of like what you want to write down the dollar value of it on the balance sheet, like whether to write down the current market rate of something or some sort of other estimate of underlying value? Is that just sort of a choice that whoever's modeling it makes, and or like does the total amount of sort of inconsistency, like extra stuff coming from capital gains for which there's no liability, sort of, is that a measure of the bubbliness of the whole system or something? Is there something like useful for me to kind of mental model to come out of that?
But the capital gains on financial assets always have a liability counterpart. Only for real assets, you don't have a liability counterpart. So the real assets is the fact that I have a house in Manhattan. I bought it for $1 million. And now the price has gone up to $2 million, the market price. So I made $1 million without doing nothing, only because the market price has gone up. So who is losing this million? And the answer is that I will not realize this capital gain until I sell my house. So at the time when I sell my house, the buyer is paying $2 million, and he would have paid $1 million without the increase in the market price. So the prospective buyer is those who are suffering the loss. Okay, now the financial markets have made so that homeowners can realize their capital gains. And those who are suffering the loss don't even know that they're suffering a loss. So in principle, if everyone were rational and forward-looking, and I want to buy a flat in Manhattan, when I see the price going up in Manhattan, I should start saving more in order to be able to afford to buy the flat. The owner of the flat will spend more because she feels richer, because their flat is now more expensive on the market. So in principle, in a theoretical, forward-looking, rational world, the two effects should cancel out on aggregate spending. In practice, they do not. But for the other capital gains, so capital gains on stocks, the price of a share of Google goes up. I own the share, so I'm happy, and then maybe I spend more. And this implies an increase in the liability of Google, but they don't care because it's not a debt. So, but in the accounting sense, it is recorded as a debt, and it also may have some consequences on the balance sheet. I hope I answered your question.
Yeah, I think you did, although I still have to digest it for a long time, I think. Thank you.
I think we have time for one more question before the stock flow modeling lab. Is there any more? Okay. Can you pass this down, please?
So, technical question. Input-output tables are tables that track for particular sectors. For example, the airline sector, you would track, okay, where, or let's say airplane production sector, you would track where are particular materials coming from, what other sectors. So it's sort of doing this type of analysis on a private, within the private sector, how is value flowing from sector to sector. I'm curious if there's been any research done incorporating input-output tables into these stock flow models anyway?
Yes, I mentioned this briefly in answering a previous question, and not for only one industry, but the whole input-output table at a given level of detail can be incorporated into stock flow approach. And actually, as I said, the accounting part of the stock flow the stock flow models can be arranged as a social accounting matrix, and social accounting matrices are an extension of input-output tables. So then it will depend on the level of detail of input-output tables that are available, and on whether this is really the question you're interested in. Maybe if you're working in a country which has severe supply constraint, then it pays to have an input-output stock flow consistent model. Otherwise, you'd never want to do all this work for all countries. It's intractable. It's too much work.